So we're going to talk about three brief things. Firstly, I think some of the conversations you've heard earlier today and you would be familiar with, inflation, interest rates, these things are talked about quite a lot, and I'm not going to add much to that, but I want to give it some context about what that actually means to the global economy, to what it means for equity market investment as well. I want to talk a little bit about numbers over narrative, and what I mean by that is a lot of times people talk a story, a narrative. We think the numbers actually make sense. Numbers are where the money is. Numbers are what the risks you're taking. So we really are focused as a firm on focusing on numbers. And I'll tell you a little bit about that as well. And then we do think we're in a new world, a world that has changed, not the world that the last 30 to 40 years, and certainly not even the world the last couple of years. And in that world, this new world to come, we think diversification into things that you haven't been involved in potentially before is probably what's needed to succeed. So let's go on. So obviously inflation, much talked about. Why do we have inflation? Well, no one really ever fully knows why inflation happens, but it's fair to say that 30 to 40 years of consistently fiscal expansion, spending money, printing money, probably the last 10 odd years, eventually those things hit a wall and you do get excess demand for services and goods, and you do get inflation, and it has snuck up and it has become quite pervasive globally. It's not just in goods and services, it's also in things like housing prices and asset markets. It's somewhat interesting that, as you can see on the chart here, that the GFC, when the housing market in the US eventually crashed, it was regarded as being an exceptionally overpriced market, and then obviously it dropped quite significantly. But what is interesting is in the last couple of years, we've far surpassed that level as well. So just another asset market that's reaching new highs of both valuation, and that is also a form of inflation that's happening at the moment. Touched on 40 years of lower interest rates. You cannot overemphasize this fact because 40 years is roughly pretty much covers most careers, and the vast majority of people in financial markets weren't around when there was an era when interest rates were actually rising. So 40 years of lower and lower interest rates has allowed asset markets, equity markets, bond markets, fixed income markets, you name it, to just go up and up and up, because the lower the cost of money, the lower your discount rate, the more you're prepared to pay for assets. So you have seen that happen. Now, why this period of time is quite unique is we believe we're potentially at an inflection point where that is going to move the other way, and that has significant implications. You can see the little yellow circle there. That's the last basically 18 months. It has started increasing, but obviously off a very low level. This has just blown that up, that period in time. And what you can see is what rates were, 10-year rates were kind of around sort of at the beginning of COVID, around about 0.5% in the US, negative in Europe, negative in Japan. Just in the last 18 months, they've actually well more than doubled. And if you take the last couple of months, they've actually continued to go up as such. So you're at 2.3, 2.4% now. So rates are going up, and that has an impact. One of the places that has an impact is where it helped the most. So before I touch on this graph on the Nasdaq, I will just explain to you why this rates on the Nasdaq and high, as an example, matter. When interest rates are very low, it doesn't matter how far away you are from your money, because by the time you get that money, it's still going to have similar purchasing power. If inflation was 1% a year and I'm only going to make a lot of money in 10 years, you could think, roughly speaking, it will have, call it 90% of its purchasing power. If interest rates were 4 or 5% a year, then that number halves in that 10-year period. So suddenly, waiting 10 years for your money actually means a lot in terms of purchasing power. So companies that are highly valued, that are growing, higher interest rates affect them the most, because you're no longer prepared to pay up front today for money into the future. The Nasdaq, which is the tech-heavy sector in the US, where most of the high-tech, high-valuation companies are listed, has been a substantial beneficiary, amongst other things, and there are other things, but interest rates cannot be discarded. It's a very high correlation to interest rates, the Nasdaq, and they have been a significant beneficiary of this lower and lower interest rate environment, which has driven it to be, well, quite expensive on most metrics. And I'll come to that in a minute, but fair to say it has been it's driven to very expensive levels. And something about expensiveness I'd like to touch on, and that is on this graph that you can see in front of you. When the Nasdaq got to previous highs 20 odd years ago, many of you in the room would be familiar with the Nasdaq bubble, the dot-com bubble, sort of running from around 1996, 97 till about just over 2000. It got to such a point of such high valuation that basically if you bought it on the top of the day, it took you 15 years, which is that yellow line there, to get back your money. So when something is the wrong price, this concept that, 3 weeks, 3 months, 6 months of a sell-off, it's back to good times again. No, when something is the wrong price, it can take a very, very long time to make back your money. And one of the key dynamics of that, which I think is very important to consider, is most equity markets do not ever trade for long at so-called fair value. So one may believe this is a certain value that things are worth, but almost every market in the world doesn't actually trade that. Generally, how asset markets work is they move from towards expensive towards cheap. So you can be very, very expensive, and then you're moving towards very, very cheap. So you can get into quite a lot of trouble if you anchor yourself around some concept of fair value. In the same basis, when the Nasdaq dropped 90% from its all-time high in the early 2000s till around 3-4 years later, it was arguably very, very cheap, but it didn't mean it couldn't get to that level. The same risk I think one should be cognizant of today is that there is that risk of valuation issue today, and it has started to come down with higher interest rates, and this could go a long way forward. So it's just something to bear in mind. And why the Nasdaq matters is because the Nasdaq has basically taken over the global equity indices, and I'll show you that in a few minutes. But effectively, the US market is 70% of the global equity market now. If you were to buy a global equity ETF or index fund, 70% of that would be the US. And of that 70%, basically a third would be the tech space, which is Nasdaq heavy. So it's a really relevant point right now. Higher interest rates put this segment of the market, which dominates the market from a weightings point of view, at risk. Let's talk a little bit about numbers over narrative. Now, I'll start off without a number and just a whole bunch of squiggly lines. The only thing to really think about without trying to spend too much time trying to figure out what's going on there is that those lines follow each other. And what are those lines? One of them, is the light yellow, is effectively the inflation rate, purchasing power index. So it's basically what inflation does, and we've inverted it, which means the lower the line goes, it means that's higher inflation. So when that line goes lower, it means inflation's going up. And you can see this goes down to 1970, so it's a pretty good data set. And what the other line is, with an 18-month lag, is the economic activity. The best source of that we've used is the ISM Manufacturing Index, but effectively think of that as the global economic activity as a very good proxy. And effectively what this shows is that inflation, with about an 18-month lag, dictates future economic activity. And there's a whole bunch of reasons why, but effectively inflation is a tax on economic growth, and it's a tax on consumer spending. So higher inflation, and that is why so many people and so many central banks and so much political discourse is around inflation and what that means, because high inflation is just not a good thing. But we currently are living in a period where we've had the first time for basically decades a level of inflation that the central banks now have to act towards. But what this does mean is we think this does lead to a lower economic environment going forward, and something to be cognizant of. The other fact I want to talk about is, in terms of numbers, is I touched on this earlier. The Nasdaq tech weight of the index is most specifically what I'm talking about. That has moved up to around 30% of the S&P. So back in the dot-com days, it only got to just over 20%, but now it's over close to 30. So there's been a significant amount of momentum of investing into a handful of very highly valued, very high quality, well-known companies we all know, but nonetheless, it's that have absolutely taken over the index to an extent that hasn't happened before. Now, just to give you some context of what inflation actually does and where it's actually impacting. So this is a recent survey of US spending intentions over the next 12 months. And it shows what actually inflation's actually doing at the consumer level. So what are people's intentions? Well, what you can see is areas like groceries, utilities, education, to a lesser extent childcare, people are devoting the majority of their consumer spending to. So it's things that you just need to live and are basically non-negotiable. And what's compensating and what has to be a lot less is entertainment, dining, travel, home improvements, a whole range of things, as you can see. And this is the dynamic that tends to happen in a higher inflation environment. It's not just that economic growth could get slower, where you spend the money changes quite dramatically, and it goes a lot less discretionary and a lot more into effectively needs. And that does have an impact on economic activity, on earnings, and on valuations, where the vast majority of the equity market is actually driven more by the lower side of this table. So that is something that we should expect to continue for some time. Now, we've talked a little bit about that there is an inflation problem going on. We're not here to forecast what inflation will be, but other than that it's an acknowledged problem that central banks are dealing with, and they've already started raising interest rates globally. Also talked about that economic activity is also slowing, or starting to slow for some of these dynamics. There are other things that are driving economic activity a bit slower. Some of that's just this point in the cycle. We've had a lot of the COVID pent-up demand now rolling over. But it's very, very rare that you raise interest rates into a declining economic environment. And the reason it's rare is because it's silly to do it if you don't have to. Who raises rates when economic activity is slowing? Because you tend to raise rates to slow economic activity, not to chase after slower economic activity. So it tends to not happen often. It's only happened 4 times in history. And the only 4 times it's happened, there's been specific reasons why it has happened that way. And the reason it is happening now is because effectively central banks globally have missed a trick, have been behind the curve. They saw 40 years of data of interest rates and inflation going one way and never thought inflation would actually show up. So they've found themselves in a bit of a quandary now and are now raising rates into a lower economic environment. That does not tend to work out well for equity investors. The 4 times this has happened historically, you can see where it's circled in yellow. You've had pretty poor outcomes in equity markets in the subsequent 12 months. We're not going to forecast what equity markets aren't going to do. I just want to highlight that this current environment, raising rates, slowing economic activity, alongside very high valuations, is a very challenging time. And that is why it does require something different to be done, in our opinion. So what do you do? What do we suggest you do? Well, we think diversification is important, and you need to diversify away from the index itself. And that's the challenge, because the index itself used to be a very good, generally broad way to diversify without having to spend too much time thinking about what you want to buy or not. But as I mentioned earlier, the US is now 70% of the index. I mean, that's quite remarkable, because the US is obviously, a dramatically smaller proportion of the global economy in both population and economic activity, notwithstanding it's obviously a very big economy, but it's 70%. So when you buy the global index, if it's matched to the index or something that's index hugging or tracking, you're really to a large extent buying the US market, which is the most expensive equity market in the world. Not only is it the most expensive equity market in the world, but it's also dominated by very few companies. So those 5 companies you can see, I think on the right there, those companies you'd all be familiar with, Apple, Microsoft, and some other names you'd know there, are effectively over 25% of the index. So you can see that not only is the US dominating the global index, but the tech space is absolutely dominating the US space within that. These are very high levels of concentration, so you're not really getting much diversification, and you are actually getting companies that are actually quite exposed to higher discount rates, higher inflation, which means lower PEs, and you saw some of that significantly impact them in January and February. There has been a bit of a rally the last couple of weeks, but I think the January-February experience does show what happens when the market gets concerned about inflation and interest rates, what it does to valuations of high-valued companies. The other thing, which I just another thing that I think is worth highlighting, is the correlation to the Nasdaq. So it's all very well me talking about the Nasdaq being expensive and at risk, but you think, well, if I'm in the S&P or I'm in the MSCI, how much does it actually link? Well, that concentration can see itself in correlation, and you can see whether it's over 1 year or 3 years, you've got numbers of sort of over 8.8, and generally in correlation, once you're starting at 0.8, that's a very close correlation. So effectively, if you're buying the MSCI, you're buying the S&P, you are having a risk to the Nasdaq, which we think is where the biggest risk sits within global equity markets from the issues I've spoken about. I'll tell you a little bit about ourselves in a minute, but we do something quite different, and because of that, our correlation, you can see whether it's 1 year, which is negative, or over 3 years is a very low number. So how do you diversify? Let's just talk about that. Well, there's a lot of places you can diversify because fortunately the whole world isn't expensive. The expensive overvaluation has been driven by a lot of momentum. It's been driven by a lot of money chasing what's been good performers. So a lot of money's gone into a very narrow pocket of equities, which has left many parts of the world far less expensive. And if we look at it on basically a region by region area, you can see we've used a few different metrics here. PE is price to earnings ratio. Just to be clear, that's how many years in advance you're paying for earnings. PB, weighted average PB, is price to book, how much you're paying for the assets, and then there's just the dividend yield. And you can see on the Nasdaq, it's quite materially more expensive versus the MSCI World, versus Europe, versus Japan. So we see more opportunity outside of the US, specifically Europe, to a lesser extent Japan, and you can see it significantly more attractively priced at a regional level. So there are opportunities to diversify into those areas, we believe. You can see our metrics over there. We are a global equity value manager, so our metrics are noticeably more attractive from a valuation point of view. Now, valuation obviously isn't everything, but I think in an environment of higher inflation, higher interest rates, you tend to want to have lower duration, which is closer to your money. And that is a proxy for almost saying lower PE, lower price to book, higher dividend yield. So just breaking down some of that diversification of how we've represented that, as I mentioned, the US is around 70% of the global equity market. In our fund, we have around 27% in the US, so it's dramatically lower because we see more opportunities elsewhere. We see more opportunities in Europe, 28%, Japan, as I mentioned. At the sector-wise, I think it's quite relevant to mention, we don't see much opportunity generally within the IT sector, which has obviously been a very successful sector the last several years, but we see that as quite challenged from a return point of view, as I've touched on. So we basically we have no money there. Where we do have quite a lot of exposure, and where we do think is quite an interesting place, is actually in healthcare. Why do we say healthcare? Well, there's a few reasons. If you think that economic activity is slowing, well, you don't really want to be too close to the economy, and that is financials, energy, tends to be industrials as well. So you can see we actually don't have as much exposure there. We've got a lot less there. Many value managers like ourselves might have a higher weighting to that because they might say that's where value is. But we actually think when you're quite concerned about economic momentum, you actually want to be careful of those sectors. So economic activity makes the value end of things a bit challenging. The inflation side makes the expensive, high growth, high valuation area also challenging. what that leaves is quite a unique opportunity within healthcare. Healthcare companies don't tend to be too affected by inflation, interest rates, economic activity. And in what's also happening in the world, and I haven't touched on this, but I think it is relevant, is there is a level of deglobalization going on. Companies want to be closer to their customers, closer to their manufacturing activities. That's been a trend for quite some years, and I think that's actually picked up quite dramatically. And even the last couple of months, what's happening geopolitically, there's some challenges about globalization. And healthcare, or certainly global healthcare companies, have one of the rare advantages to have a global customer base, but they don't need to have a global manufacturing footprint because of the way that industry works. So they actually are quite unique in terms of their opportunities and their risks in that space. So that is why it is, by a long shot, our biggest exposure. These are the sort of shares that we think fit in well for the environment we're in at the moment. And as you can see, we've got quite a lot in healthcare. You'll probably know some of those names. Just to give you some context, if of interest, why, talk about a company like Sanofi. There's a company that probably many of you know. A global healthcare company. They do vaccines, they do consumer healthcare, they do pharmaceuticals. But the whole company is worth about $100 billion, give or take. They make about $8 billion a year profit. So, over 10, 11 years, you get back all your money. And that's after spending about $6 or $7 billion in R&D to keep the company going in perpetuity. So, and they've got no debt. So a company like that, you don't really need to believe in growth. You don't need to believe in any disruption. You don't need to believe in anything. You can probably make back your entire investment over 10 years if the company doesn't grow, because the earnings and the cash flow will basically cover that. And they give most of that back via dividends and even share buybacks. So that's why an example of the kind of companies, the kind of sectors we think actually do very well in the current environment. I'll tell you a little bit about ourselves before I touch on this, because I think we want to talk about income, and income to us is a very important thing. So we are, and I've obviously talked about, we're a global equity manager. We run a concentrated portfolio, value investing. Doing it for 16 years. I've been there from the beginning. One of the key things we focus on is not just buying undervalued equities, but also have a process that generates a higher level of income. So we generate north of 7% of income a year. I'll come to a graph a bit later about how that gets distributed. But we think income is very, very important. And I wanted to just highlight why it is so important. If you look at income over the last 140 years. So forget about trying to focus on any 1 year, 5 years, 10 years. Let's go to as much data as we can find. So every single decade since 1880. What this table is showing you in dark blue is the level of income. Now, obviously not ours, because we've been going 16 years, not 140. But anyway, this is dividends from the equity market. It's over a 10-year period, how much you got from dividends and how much you got from capital appreciation. Capital appreciation would be shares going up. The income would be the dividends and the reinvestment of those dividends. What I think is quite noticeable, one is every single decade, income's important. So it doesn't matter how you think about equities. If you were to delete the income component, the dark blue line, you can see you would come up a lot short. So income absolutely matters. And sometimes it's the only thing that matters. Whether it's the 1910s, 30s, or 2000s, your entire return was income. So income matters. Further, generally, when you have a period where capital growth has been very strong and a very big component, you tend to have a weaker capital growth component going forward. And it's worth mentioning that the 2010 to 2020 period was amongst the highest ever capital gain component of total return. So it was a very, very good time to be an equity investor and anticipating share prices going up. And we saw that on some of the charts earlier. But we think going forward, income's going to matter a great deal. And income absolutely matters in an environment of when you have a starting high valuation and improving higher interest rates, higher inflation, and lower economic activity. That is the perfect environment where income will be far more important going forward, and we think that is something that we're very excited about ourselves, and we have a very high income generating process for our fund. Just to highlight, we only invest globally, but I thought we're obviously based in Australia, and a lot of people are Australian equity investors, and I've always thought this chart's always quite interesting to highlight. So Australia, as most of you know, has not had a recession for basically 30 years, so it's been a very, not just a lucky country, but a very successful country. It might be quite surprising to know that the absence of dividends in Australia, you would have made no return, but zero return. Forget about inflation adjusted, zero return over the last 15, 16 years, and not much over 20. The yellow line is the price of the index, and you can see it kind of hasn't gone anywhere. I mean, it ebbs and flows a bit, but if you bought it in 2006, you've made no money. Your entire return for the better part of 2 decades has actually been the dividends from Australian shares and the reinvestment of those dividends. So I think that just does highlight how important dividends are and income is. Now, we earn our income a slightly different way. That's why we earn a very high amount, but it does highlight that dynamic. So talking a little bit about ourselves, as I said, we've been running for 16 years. We have a process that generates a higher amount of income. We do that in the manner in which we buy the shares we want to own, without going into any great detail here, but we sell put options on shares we want to own and get paid a premium. That's the manner in which we enter into positions. That generates a high amount of income, and we distribute that. So one can see whether it's 1 year, 3 years, 5 or 10 years. In dark blue, we're able to distribute a high amount of income, which we distribute quarterly, and that's sort of a north of 7% number consistently, underpinned by our high income generating component. And that obviously reflects very well against dividends that you could earn both in Australia, in the ASX, or globally, which is a lower dividend yielding index. So our income, we think, will be sustainable even in this current environment, and we think income as a component of return, as I mentioned, is a very important thing, as I've touched on. So, just to summarize, we think inflation is definitely on the cards. It's there. We don't think it's transitory, but we're not making a view about it. But we do think that the market itself is not pricing in higher inflation and higher interest rates, and one should be very cognizant that there might be a new world ahead of us, and in that new world you need to do things differently, and lowering your duration, lowering your PE exposure, having a greater exposure to lower PE companies, higher dividend, higher free cash flow yield, is just a very important thing. Having income as a component of return is a very important thing. Diversifying away from the expensive parts of the market, specifically US tech, is very important. And all of these things are happening now. In fact, January, February was a very big wake-up call, I think, towards what can happen. The last couple of weeks, you've had some recovery, which is quite common the case. I actually think that gives an opportunity for investors who didn't get the chance to reposition appropriately. There's a bit of an opportunity now to take advantage of some of the recovery that's happened, to do that. That's why we feel pretty good about our place in that world. Just a little bit about on ourselves. So we, as I said, we run about 600 million. We've been going for about 15 years or over. We only do one thing, which is a global equity fund that generates lower risk than the market, high level of income into a portfolio of value shares, effectively. We're on most major platforms, highly recommended by Zenith. We recently launched an active ETF. We absolutely would love, if what we say and what you hear is something you'd like to hear more of, we'd absolutely like to hear more from you. Mitch Hannigan's in the audience somewhere. He sort of handles on the distribution side, so please reach out to him. And on that, I think we're running a bit ahead of time, but I think it's important, being the last speaker, not to run over time. Here with AMP, we're sponsoring some drinks, so hopefully some of you can join us to that as well. And on that, thank you very much for your time.